to money market guy, Scott Martin. Scott, that's my thesis. That's my story. What's yours?
I follow you, man. I think you brought up something really interesting, which is a comment about the bond market, Charles. I think this stock market, both domestically and internationally, especially with all the negative interest rates overseas, I think that's what's feeding a lot of these higher prices, is the fact that low interest rates, easy access to capital, a lot of stock buybacks are pushing prices higher on the equity side.
There's no doubt about the stock buybacks. What do you make of the dollar, though, is getting a little weak today. It's pulling back maybe, and gold's making a big move. I mean, it feels like people, Scott, are looking for alternatives.
They have to. I mean, these days with stocks at record highs, depending on your favorite index, with bond yields at record lows to some degree, you have to find things like real estate. We've liked gold all year. We continue to do so, especially with the Fed on hold here as the economy recovers, yes, but still struggles to really heat up.
So the market, where it's valued right now, I mean, I don't think you'd put it all in gold. How does an investor who may be sitting on some cash go from here? Do they continue to wait it out, or do they say, heck, you know what? There's a good chance we could rally if the Fed doesn't do anything this year?
I think there's a good chance we could rally. I think as we get some more clarity on the election, too, I think you don't want to stay out too long. I think you're going to get opportunities. But, hey, Charles, I love gold as much as a gold member from the Austin Powers movies, because I think gold is going to provide that non-correlation, which means it's not going to move like stocks. It's not going to move like bonds. That's why it needs a place in your portfolio.
Let's talk about valuations for a moment. I find it very compelling that the hottest stocks in this market are also typically the ones that are safest. In other words, utility is up almost 20%. That is that's crazy to me. And yet the natural instinct for most investors is if they want exposure to the market and they're afraid, they're going to buy defensive names. But aren't the defensive names way oversold here?
It seems like it. You know, you mentioned utilities with a crazy move this year, one of the best sectors, if not the best in the S&P. I'd throw on telecom there, Charles, as well, and even boring consumer staples. These are good dividend payers. They're good cash flow businesses. It just shows you the risk appetite that a lot of investors have had this year has been pretty meek. It's been pretty like going after these dividend payers, get these cash risk businesses, and avoid the cyclical stuff.
All right, in the last 24 hours, last 18 hours, we had a lot of earnings out. Ralph Lauren is up big today. Fossil's making a little bit of a rebound here. And yet Dollar Tree is at an all-time high. I mean, if you look at the stocks that are moving, it seems the Dollar Tree reflects the economic reality that most people tell us that they feel. But now some of these luxury names are coming back. I mean, is that telling you anything?
Not too much. You know, these are kind of here and there. I mean, look at Michael Kors today. That's down. You know, Disney had an interesting move overnight and actually rallied into trading today, so that's kind of neat. I'll tell you, though, I mean, a lot of these retail names, especially as we're seeing come out, Coach recently, these are a tough spot to be. There's kind of landmines everywhere, so I'd be careful in the retail space, and if you're looking at playing earnings, I'd stick in the tech area.
Real quick, then, before I let you go, Scott, what's your greatest fear? What are you worried most about, and what would maybe make you make some changes in your portfolio?
Without a doubt, man, the Fed raising interest rates, which I don't think they're going to do before the election. But I think with economic data, looking at maybe GDP in the third quarter here coming maybe in close to 3%, the December meeting for the Fed, Charles, is in play now, I think, for a rate hike. And I think that eventually will hurt the market because this market loves low interest rates. And that means the Fed needs to stay on the sidelines if you want to see prices stay up here.
Scott, you're one of the best, buddy. Thank you very much. Appreciate it.